Imagine waking up to find that in just 3 months, a staggering $15.4 billion has flooded into a single city's property market.
Yeah, it's a massive number.
Right. You rub your eyes, you check the numbers again, and, well, it's real. That is exactly what happened in Singapore in the first quarter of 2026. And just to put that figure in perspective for you, that is an astronomical 166.5% increase from the exact same time last year.
Wow.
Yeah, it's the kind of number that just makes you stop whatever you're doing and wonder what on earth is going on behind the scenes.
Well, I mean, when you see capital move with that kind of velocity, like 15.4 billion in just 90 days, it tells you that a fundamental structural shift has occurred.
Right.
Institutional money, it does not move by accident. It moves because a very specific set of conditions has been met, unlocking doors that were previously, well, bolted shut.
Yeah, and it's easy to just stare at a massive headline number like that and feel, frankly, completely overwhelmed by the scale of it. But today, we are going to break it down for you. We're doing a deep dive into a thick stack of recent market briefings, official Ministry of Finance policy announcements, investment firm reports from Knight Frank and Savills, and the latest coverage from EdgeProp and the Business Times.
It's a lot of material.
It is a bunch of material, yeah. And our mission for you today is to look past the sheer volume of that cash. We are going to decode 3 specific under-the-radar signals that explain the actual mechanics of why capital is moving like this, and what it tells us about Singapore's status as this ultimate global safe haven.
Right. So to understand the avalanche, we first have to look at the pebble that started it.
Okay.
And surprisingly, that pebble isn't a shiny new luxury condo development. It is actually buried in a recent earnings report from the industrial sector.
Wait, the industrial sector. Okay, let's unpack this. Because usually when people think of a white-hot property market, they picture, I don't know, penthouses overlooking the marina, right? Not logistics warehouses.
Yeah, exactly.
So what is a report from the industrial sector telling us about $15.4 billion?
Well, it is telling us that the underlying math of real estate is finally functioning again. We are looking really closely at AIMS APAC REIT.
Okay.
They recently reported that their distribution per unit, or DPU, for the second half of 2026 grew by 4.1% to $0.0513.
Right.
And that growth, it was driven by higher rental income and just a broad recovery across their whole industrial and logistics portfolio.
Okay, at 4.1% growth in distribution, on the surface, I'll be honest, that sounds like a perfectly fine, steady, almost boring number.
It does sound a bit boring, yeah.
I mean, I'm struggling to see how a few cents of distribution growth triggers a multi-billion-dollar market surge.
Well, the significance isn't just the 4.1% itself.
Okay.
The significance is what that growth proves. It proves that positive carry has returned to the market.
Positive carry?
Yeah. Let's look at the broader economic context driving this. The CRA, the Singapore Overnight Rate Average, which is basically the benchmark that dictates borrowing costs, it's currently sitting at 1.14%.
Ah, okay, so borrowing costs have come down significantly.
Yes.
Let me try an analogy here just to see if I'm tracking the mechanics.
Sure, go ahead.
It's like if you borrow money from a bank at 2% interest to buy a lemonade stand, and that stand pays you a 5% return.
Right.
You pocket the 3% difference. But for the last few years, the math was backward, wasn't it? It cost more to borrow the money than the lemonade stand was actually making.
Exactly. You were losing money just holding it.
But now the machine is printing money again.
The lemonade stand analogy captures the core concept perfectly, yeah. But let's, scale it up to institutional size to see the real impact.
Okay.
Institutional real estate is fundamentally a margin business. Between 2022 and 2024, the market went through this brutal period of what we call distribution compression.
Right, because interest rates spiked incredibly fast.
So fast.
Yeah.
And suddenly, the cost of debt was way higher than the capitalization rates, the yield of the properties. So these massive funds, they were essentially bleeding money on the spread.
Yeah.
They were holding billion-dollar lemonade stands that cost 5% to finance, but only yielded 4%.
So they just stopped buying. I mean, they just sat on their hands, which froze the whole market.
They had to. There was no alternative.
Yeah.
But with SORA down to 1.14%, borrowing costs have finally fallen below the cap rates for well-structured portfolios.
Right.
The return of positive carry is the green light. When that debt-to-yield ratio flips back into the black, institutions don't just buy one lemonade stand.
Oh, I see where you're going.
Yeah, they refinance their existing debt to free up capital, and then they buy the entire block. So that 4.1% DPU growth from AIMS APAC REIT. It's a canary in the coal mine showing us that the yield equation has fundamentally healed across the board.
Okay, so the math makes sense again. The institutions have the all clear to deploy capital because the debt isn't suffocating them anymore. That definitely explains the volume.
Okay.
But if I'm managing a massive pension fund, I'm not just blindly throwing money at office blocks right now,
Yeah.
especially with, remote work trends and all that. Where is that $15.4 billion actually finding yield?
That's the perfect question. Capital is flowing really heavily into alternative residential formats.
Alternative residential.
Yeah. Specifically, we are seeing a massive institutional push into co-living spaces.
Okay, I read through the sources on this, and I have to push back here because it seems completely counterintuitive to me.
How so?
Well, the reports highlight this deal where Weave Living partnered with Nuveen Real Estate. And Nuveen is a heavyweight.
Oh, massive.
They are a U.S. institutional investor managing over $150 billion globally.
Mm-hmm.
And they just partnered to acquire a South Korean co-living asset for roughly $16 million US. I mean, why is a massive pension fund buying up co-living spaces? Isn't that just like a glorified student dorm? Or maybe a post-pandemic fad? Why not buy a traditional CBD skyscraper?
Calling it a glorified dorm is exactly how retail investors viewed the sector 5 years ago.
Right.
But institutional capital sees it very differently today.
Mm-hmm.
They are recognizing co-living across the whole Asia-Pacific region as a structurally sound, highly efficient asset class that will generate reliable yield for the next decade.
Wait, really? I get that a $150 billion fund is throwing money at it, but what actually makes it structurally sound?
Wow.
Like, what happens when these young professionals age up and want real houses? Doesn't the whole co-living model just collapse if it's just a stepping stone?
See, the model doesn't collapse because that stepping stone is getting much, much longer. There are two massive structural shifts driving this right now.
Okay, what's the first one?
First, urban housing affordability constraints are reaching a breaking point.
Yeah, I mean, we all feel that.
Right. In major global cities, traditional housing has just become prohibitively expensive. Young professionals, expats, even domestic upgraders, they are being priced out of traditional leases, let alone actually buying a home.
Right.
So they're staying in the rental pool much longer than previous generations did.
So it's basically a captive audience.
It is a massive growing demographic. And second, you have to consider the professionalization of the operators. Weave Living and others, they have turned these spaces into highly efficient businesses. They are maximizing the yield per square foot in a way traditional apartments just cannot do. By shrinking the private footprints slightly and providing high-quality shared amenities.
Like massive kitchens and gyms and workspaces.
Exactly. By doing that, they can fit more rent-paying tenants into the exact same building envelope while still offering this attractive, fully furnished lifestyle.
And we're seeing this exact same thesis play out aggressively in Singapore too, right? Because the sources note a local operator, Coliwoo, launching a $218.5 million portfolio sale.
Yes.
That's 7 freehold living assets, student hostels, serviced apartments, and it's across premium areas like River Valley and Balestier.
And just prior to that, Weave Living and BlackRock made a $100 million acquisition in Novena.
Wow.
You're looking at global asset managers literally swallowing up entire portfolios of alternative residential spaces in one go.
Well, because if you look at Novena, you have a massive medical hub right there. You have healthcare professionals needing short commutes. You have international students, corporate expats. It's an incredibly sticky demographic. They aren't going anywhere.
Precisely. And when you have a $150 billion fund to manage, you crave that kind of reliable, stabilized income stream.
Right.
Co-living provides high occupancy rates.
Right.
And because the lease terms are often shorter and more flexible, the operators can actually adjust rents dynamically to keep pace with inflation.
That makes a lot of sense.
The Nuveen deal in South Korea and the Coliwoo and Weave deals in Singapore, they are evidence of a broad, APAC-wide institutional reality. Alternative housing is the new core real estate.
Okay, so we have the global institutions hunting for yield in co-living spaces because the borrowing math works again.
Yes.
But there is a completely different player in the Singapore market operating on an entirely different set of rules.
Oh, absolutely.
I'm talking about the local, ultra-high net worth individuals and family offices. While the massive funds are chasing yield, what are the ultra-wealthy chasing?
They are chasing wealth preservation through absolute scarcity.
All right.
And they just got a highly technical but incredibly important green light from the government.
I spent a lot of time on this specific Ministry of Finance announcement because Honestly, it feels like reading a foreign language at
It
first.
is very dense, yeah.
The MOF issued a clarification regarding how the additional buyer's stamp duty, or ABSD, applies to non-strata residential properties. But before we get into the tax rates, help us visualize what we are actually talking about here. What is non-strata?
Okay, let's draw a clear distinction. When we talk about strata properties, we generally mean condominiums.
Okay,
You own the airspace of your specific unit, but the land itself is shared among all the owners in the building.
got it.
Non-strata refers to landed properties where you own the physical earth it sits on. And in Singapore, the absolute pinnacle of this category is the good class bungalow, or GCB.
Just to put some concrete numbers to this for you, the sources note that in 2025, the good class bungalow market saw 36 deals totaling $1.36 billion.
Yeah,
That's an average of $2,134 per square foot. And that price is largely just for the dirt. I mean, the house itself is almost an afterthought.
it really is. Good class bungalows are the most exclusive, heavily zoned, and tightly constrained tier of real estate in the entire country. There are only about 2,800 of them in existence.
Yeah.
You also have conservation shop houses and cluster homes in this non-strata category. Now, the recent MOF ruling clarified the ABSD computations for complex transfers of these non-strata properties,
Okay.
specifically when dealing with transfers within family structures, corporate entities, and trusts.
Right. And here is where I need you to help me make sense of this because I am genuinely baffled.
Okay, what's the confusing part?
The sources are very clear that this ruling did not change the actual tax rates. The ABSD rates remain incredibly steep. It's 20% for a Singaporean buying a second property. It's a punishing 60% for a foreigner buying any property.
Mm-hmm.
And it's 35% if the property is transferred into a trust. If I'm getting taxed 35% just to put a house in a trust for my kids, I'm not exactly celebrating. Why does a mere clarification make these ultra-wealthy family offices excited?
Well, you're looking at this through the lens of a retail investor trying to maximize a return on a single transaction.
Fair enough.
Family offices managing legacy wealth, they think in decades, if not centuries. For a family office dealing in multi-million-dollar irreplaceable assets, regulatory uncertainty is far more destructive than a high tax.
Wait, that is a fascinating shift in perspective. Uncertainty is worse than handing over 35% of the property's value to the government.
Let's walk through a scenario. Imagine you are the principal of a family office structuring an intergenerational wealth transfer.
Okay.
You have a $40 million good-class bungalow that you want to place into a complex trust structure to ensure your grandchildren are provided for.
Sounds nice.
Right. But if the rules around how that 35% stamp duty is calculated are ambiguous, maybe it depends on how the beneficiaries are defined or the exact timing of the transfer, the legal and financial risks are immense. An unpredictable audit or a retroactive penalty on a $40 million asset is an absolute nightmare.
So they just avoid making the move at all. They sit on the sidelines, just like the institutions did when borrowing costs were too high.
Exactly. Until now. The MOF clarification removes that transaction ambiguity. It doesn't lower the cost of entry, no, but it provides a clear, highly regulated step-by-step framework.
I see.
It is essentially the government handing them the official rulebook.
So they might hate the rules. Nobody wants to write a check for a 35% or 60% tax. But once they know the exact parameters of the game, they can execute their estate planning strategies without fear of, stepping on a landmine.
Right. And furthermore, it proves to global wealth that the Singapore government is completely committed to maintaining a transparent, well-regulated environment.
Yeah.
For ultra-high net worth capital fleeing chaotic jurisdictions, that transparency is worth the price of admission. They view the tax not as a penalty, but basically as a premium paid for absolute security.
Which brings us to the ultimate synthesis of all these different sources. We have these three distinct signals. We have the returning yield unlocking institutional debt. We have the massive pension funds validating alternative housing like co-living. And we have the regulatory clarity giving family offices the confidence to execute transfers on ultra-luxury homes.
Pulling all of this together gives us the complete picture of Singapore's property market in 2026. And it is entirely defined by a rapid, aggressive shift toward asset scarcity.
Yeah, because the reports mention that Singapore is heavily benefiting from capital-fleeing geopolitical tensions, particularly the ongoing conflicts in the Middle East and economic uncertainty over in Europe.
Yeah.
Global investors are basically looking at a world map and zeroing in on Singapore's political stability, its transparent property rights, and its ironclad rule of law.
It functions as a geopolitical vault. But the critical insight for you to take away is that these investors are no longer just buying Singapore property is a broad, generic category.
Right.
They are highly selective. The market is experiencing what the reports call a scarcity spectrum shift.
The scarcity spectrum. Break that concept down for us. What does that actually look like in practice?
Well, capital is ruthlessly abandoning assets that can be easily replicated. Consider an aging 99-year leasehold condominium in the far suburbs.
Okay.
It doesn't have a strong anchor for demand.
Right.
It isn't next to a top-tier primary school. It isn't integrated into a major transit hub.
Right.
Those generic assets are facing massive price compression because buyers, developers can always just build another condo right next door.
Yeah, there is no moat protecting the value of that suburban condo.
None at all. So the capital moves completely to the other end of the spectrum, targeting assets that are physically or legally irreplaceable.
So if we look at the scarcity spectrum, it sounds like global investors are playing a high-stakes game of musical chairs, but they only want to sit on chairs made of solid gold.
That's a great way to put it.
I mean, they aren't trying to flip a standard apartment for a quick 100-grand profit in 3 years.
No, they are buying immunity. When a family office pays $40 million for a freehold good-class bungalow, or an institutional fund buys a portfolio of conservation shophouses in the CBD, they are buying immunity from future supply gluts.
Because the government physically cannot create more central freehold land.
Exactly. They are buying immunity from sudden zoning changes. They are holding these assets for 10 to 20 years, focusing purely on wealth preservation and intergenerational transfer.
Wow. So they were willing to pay the 60% foreign buyer tax or the 35% trust tax because they are securing a permanent piece of a stable, geographically constrained island in an increasingly unstable world.
It really reframes that initial $15.4 billion figure we discussed at the start.
It really does.
Retail observers might look at that surge and scream that it's a speculative bubble waiting to pop.
Yeah.
But the data tells a completely different story. It is highly calculated, long-term capital anchoring itself to safety.
And that is exactly why the math from our very first signal is so foundational. The return of positive carry means the giant institutions can finally afford to make these massive long-term plays again.
Right.
The validation of co-living means they have found new, highly efficient ways to squeeze reliable yield out of expensive urban land while they hold it. And the MOF clarification on ABSD means the local and incoming legacy wealth can confidently lock down the absolute rarest land at the very top of the market.
The market is fundamentally bifurcating based on true scarcity.
Yeah.
The top end, the bungalows and the shophouses, is being locked away in family trust for generations. And at the same time, massive institutional capital is consolidating the yield-generating middle and lower middle tiers by buying up entire portfolios of co-living spaces and student housing.
Which leaves us with a lingering and rather profound thought to mull over as we wrap up today's deep dive. We started by marveling at a $15.4 billion flood of capital.
We did.
But it turns out that flood isn't lifting all boats equally. It's carving a very specific, very exclusive new landscape. If massive institutional funds are swallowing up entire buildings for co-living and ultra-wealthy family offices are hoarding the irreplaceable landed properties, the absolute top and the reliable bottom of the investment market are essentially being locked down by giants.
Yeah.
So what happens to the shrinking middle? As true scarcity is completely bought out and placed into institutional vaults, where does the everyday investor go to find value in the years to come?